Good morning and welcome, Picker Radio News Hour. Joe and Jason on this Tuesday. Hope it finds you well out there. The National Championship football game. Miami and Indiana. Indiana, the new national champions. Who would have thought that? Well, you know what? I guess it does prove money can buy you anything. A lot of people are like, wow, Indiana, because they've been they're not a good football team. How the heck did they do it? Well, they have an alumnus. You may, I don't know if did he graduate? I'm not sure. But you may know him, Mark Cuban. Yes. That's how, if any of you were wondering, how did Indiana get good at football? Now you know, yes. Because the era of paying college football players massive sums of money. But, hey, you know what? They got us something different, so I'll take it. It was actually a pretty good game. We got the Super Bowl, well, close to it. I guess the semifinals are coming up, and, we're getting ready. Barrett Jackson is in town here in Arizona. We got the Phoenix Open, right? The People's Open coming up, and then that's kind of really... for me, anyway, that's like the end of the holiday season. We got to get through all that stuff. And then it's funny how distracted people can get over their sports, especially football. So once that comes to an end, people start paying attention. And of course, the next thing a lot of them are like, oh my gosh, I got to pay my taxes, right? That's usually how it goes. Our toll-free number, 800-951-0592, the website at allamericangold.com. And man, yesterday, MLK, our markets were closed. We've got bad things happening. Listen, they were already happening last week. The Japanese bond market unwinding. It continues again today. Let's just say the yen carry trade is over. In Japan, their new prime minister, she wants snap elections. So her party doesn't have enough votes yet. They're calling for new elections, like next month, because they want to spend even more money and cut taxes, right? So taking a play out of the Donald Trump playbook, it is overwhelming. Bond yields skyrocketing everywhere, including right here at home. Matter of fact, the 10-year note, 428, the highest I've seen in a while. The 20-year and 30-year notes are really starting to behave very poorly. In Japan, they had a very bad auction yesterday. It was a 20-year auction, almost a 30 basis point move in yields. And again, we have the issue with Greenland and now, pension funds, sovereign wealth funds inside of Europe that are holding treasuries are saying that they're going to start unwinding those, saying the United States is no longer a good risk. On top of this, like we said, Japan, it was almost, it was really, Jason, just a matter of time before the bond market started showing issues again. Because we told everybody, listen, the spending hasn't even really started yet. Mm-mm. And now the Japanese are like, hey, quick, let's have a quick new election. Let's get some different people in their, form of Congress so we can cut taxes and spend even more money. In other words, let's really go into debt.
Yeah, I don't know if Japan spending a whole bunch more money is really that might be more problematic for the economics of the world than America. I mean, their debt to GDP has always been so horrible for so long now. I mean, if they spend more money, that's why they were cutting rates. That's why they were raising rates and cutting spending and trying to. They were probably getting ready for some inflation, right? And so I guess they're just not on the same page as the rest of the world, which is wanting to inflate everything out and destroy the poor. And how much more of the middle class is going to get flushed out this next couple of years, Joe? I mean, that's what we're looking at. How much more are we? I keep seeing more and more videos and more people saying that if you're earning $140,000 a year, it's very likely you're in poverty class now. $100,000 a year coming into your home, and you're considered poverty. I don't know where poverty. I don't know where is that where you can just barely pay your bills. I guess that considered poverty.
Well,
now?
Yeah, I don't. That's a great question.
They're moving that stick, right? Yeah,
right. That's a really good question. Now, and of course, last but not least, we can't forget Davos. Yes.
Oh boy.
They're all going to be there. Trump's going to be there. Japan's going to be there. The Treasury Secretary was on TV trying to calm nerves. I don't know if it worked. I've been in touch with my economic counterparts in Japan, and I'm sure they will begin saying things that will calm down the markets. Yeah, see, it's not what you do. It's just what you say, right? Remember, isn't that supposed to be the opposite? It's really not what you say. It's what you do. Sorry, Scott. I think you got that backwards. Oh, wait. I forgot. We're talking about bankers. Yeah, it is about what they say. We'll be back. 800-951-0592. Wow. I'm just watching here. This is going to be very interesting. It does appear that the Treasury Secretary, at least so far, has been cast aside, not helping the markets. Let's get into it here. It could be worse. It might get worse. So right now, the Dow is down between 500 and 600 points. That's not bad. It's not bad because they're hoping beyond hope. Okay, cooler heads are going to prevail. I don't know. The S&P's down 77. The NASDAQ's down 300. I've been telling you, the 10-year note 428. What the heck happened? The German bond yields higher. We're watching Japan. So what was it? Right before I left town. So after the new year, the Japanese 10-year note broke 2% for the first time, I don't know, sometime in the 90s, right? Listen to this. 2.35 on their 10-year note. Bonds are not supposed to move like this. And again, the problem is, I'm talking to you about 10-year yields. The bigger problem is in the 20, 30, and Japan actually has a 40-year bond. Just no demand. The yield curve steepening dramatically. Crude oil's up almost $1, as predicted by us. Gold just ripping the cover off the ball. It's up $70 more, 47, 42, 47. Let's just run it. 47, 45, almost at the highs of the day. Silver been as high in the 95s, right now in the 94s. But I got the feeling someone was trying to get out of some more shorts. Who was it? I forget what bank it was that just took another $600 million loss trying to short silver because they're not smart. Listen.
I'm looking at the price on the website real quick, Joe. I'm waiting to see that first time we have to put $5,000 on a gold piece. We're at $49.40, I see, for 20. So It's coming.
Well, listen,
man.
I'm glad you brought that up. I'm gonna have 20s on sale today. $48.95. If you buy 20 or more, $48.75. I still have about a case, about 25 rolls of Silver Eagles. Remember, they were in a sealed case. 2024s there were still. So let's update silver very quickly. No change. The mint out. No word if they're gonna not be out. Premiums on back dates. What do you think happened, guys? Yeah, they got more expensive. I'm going to leave it. Rolls of Silver Eagles, 21.25 until I'm out of them. And once I'm out of them, I don't even know what the price is, Jason. Do you know? What are we on Silver Eagles? We're probably approaching $2,300.
$55,500 for a case, and we got $2,235 on a roll. So
$2,235. So you're going to be able to pick them up for $2,125. Saving $110. Yeah, you can't. Just telling you. I know a lot of people are looking at trading some silver for gold. You can do that. You can also, don't forget, by the way, wait till tomorrow's show for Texit, you guys. I will say this real quick. First person to call me and say, hey, get me a 9-pack of Texit, I'm going to give you $2,000 worth of Texit coin. When Texit coin goes above $2, I think, and 25 cents, you'll have already made your money back. That's how fast it'll be. But first guy's got to do it. Now. You can trade gold, you can trade silver, you can do it. I can put it on a credit card. I don't care. 800-951-0592. So $20 gold pieces, $48.95. Okay, I'm going to tell you. If you have money sitting around in your bank, what are you doing? What are you doing? Are you that reckless? Tell you what, make it, because I forget how expensive stuff is. 10 or more, $48.75. Okay, there you go. That's the best I can do. And then I've got the Silver Eagles. It's crazy. $21.25. So what happened? Obviously, the bond market started to go south late last week. Then, of course, the whole Greenland thing. But again, it's interesting how that comes up as Japan was falling apart anyway. Over the weekend, Deutsche Bank says that Europe has leverage over the United States over this dispute in Greenland, or there was an or in that, or 8 trillion reasons why the U.S. has leverage. So this is coming down to, right, I don't know, is this like a game of chicken, right? Who's going to blink first? Here's what they wrote. European countries own $8 trillion of U.S. bonds and equities. Now, most of that, I would say over half of that in equities, all right, U.S. stocks. Almost twice as much as the rest of the world combined. In an environment where stability is being disrupted, it's not clear why Europeans would be willing to play this part. But guess what? Apparently they are. After Treasury Secretary Scott Bessent appeared this morning, it appears that European governments are aggressively selling U.S. debt to counter Washington's threat over Greenland. Now, the Treasury Secretary says that would defy logic. Bloomberg is now reporting Danish pension funds are planning to exit U.S. Treasuries by the end of the month on concerns that policies of Donald Trump have created credit risk too big to ignore. The United States is basically not a good credit, and long-term, the U.S. government finances are not sustainable. Interesting. This would be a very, very quick exit out of any major position. By the way, this pension fund, $25 billion. They held over $100 million in U.S. Treasuries. And on top of this, Jason, other pension funds and sovereign wealth funds are saying that they are preparing to do the very same thing. And again, this is a time already. Bond market's already stressed because of Japan. The U.S., like we said to everybody earlier this week, Jason, we haven't even really started the debt yet. We're almost at $39 trillion, but this thing is getting ready to escalate.
Yeah. Starting in late February, we're going to start seeing a lot of money pouring in here to try to soften what Joe is talking about. You know, when foreign nations start selling off debt, if they don't replace it by buying new debt, and here's the thing, the rates are starting to go down. Why would you replace the new debt with lower interest rates and sell the old debt? The only good play, if you're interested in the treasuries, is to buy more, right? So if you're selling, especially if you're selling the higher rate stuff, of course, I don't know what they're selling. I guess they could be selling some old stuff. They could be selling some old stuff, right? This whole thing could be could be a mirage, right, Joe? It's all numbers, right?
It's not good. And now that rates are going back the wrong way. So remember in bonds, how does it work? It's the opposite of what you think. Higher yields are bad for bondholders. Lower yields are good for bondholders. So to Jason's point, okay, I have, and let's just say 10-year notes. So where were we 10 years ago? Well, that was 2016. Well, what were rates? Oh, yeah, I forgot. They were zero. Right? 10-year note was yielding what? Like 1%. Now it's approaching 4.30. 4.3%. That is a bad deal. And it's something where when I'm looking at this, especially this one pension fund in particular, holding debt to maturity, at least you don't have to take the loss, right? Hey, I still got my 1%. Going to be interesting here. Now, again, if they did it in short-term debt, if they were just buying 3-month, 6-month, 1-year notes from the U.S. government, it won't be as bad as people that were holding that longer-term debt, but not. This is not a good development. We're going to have to see what happens in Davos. Ray Dalio, remember another guy I keep telling you got to pay attention to, said that this is becoming a very difficult situation on the other side of trade deficits and trade wars. There are capital and capital wars. If you take the conflicts, you can't ignore the possibility of capital wars. In other words, maybe there's not the same inclination to buy United States debt any longer. And Jason, this is something we keep telling everybody. You know, I go back to Jeff Gundlach. Remember what he said when we were cutting rates? Hey, rates aren't going to go lower. I've been doing this 25 years. We've always had a pattern. The Feds cut rates, bond yields go lower. Feds cut rates, bond yields go lower. Fed cuts rate, bond yields go lower. Well, guess what? The Fed has cut rates 7 times. The bond yield was 3.8 on the 10-year. It's now 4.3. It's not good. I want to highlight, remember, we did other education in this. Reverse repo good, right? There's no money in it. Repo bad. Uh-oh. Guess what? More banks at the repo market again. How high can rates go before something cracks? We'll be back. 800-951-0592. Gold's up $72, $73, $74. So not yet. $47.45. Silver, 94 and a quarter. Look out. Will we see? We already saw $95 earlier today. We'll probably see it again before the day is over. Don't be surprised. The last remaining Silver Eagles, 21.25. Whatever is left. And then, of course, the $20 gold pieces, $48.95. 10 or more, $48.75. At 800-951-0592. So Ray Dalio, he's in Davos. We're going to hear a lot of these Davos guys talking about countries' seemingly lack of confidence or lack of willingness, less willing to finance the United States. At the same time, what is the Bank of Japan doing? I don't know. They need to go back. Right? Here's the hard part, Jason. They need to go back and buy their debt. Right? They got to go back to quantitative easing in a huge way. I don't know how else it will work. Here's the problem. I wonder if the Bank of Japan is watching the United States. Because think about what we've done. We've cut rates 7 times. We've started quantitative easing again, and yet rates are going the other way. I wonder if Japan's like, man, we really can't do it again, because if that doesn't work, the game's over, right? The game would be over. Again, this is the bubble we're waiting for. Do we have more time? I hope so. Right? I mean, that's the hope, right? Please. We want as much time as possible before it blows up, right? But it just seems like every little thing has become a big thing. And I get it, right? I get it. Yeah, we gave all these countries, we were too nice. We were too nice to them. Guys, remember, that was the deal, right? We're gonna make it worth your while, but you finance our debt. And then it got to the point where, we may need to go the other way with it. And this is kind of where we're at today. Said that, back to Dalio, when you have conflicts, international geopolitical conflicts, even allies do not want to hold each other's debt. They prefer to go to hard currency. What is hard currency? What is he talking about? Oh, yeah, that's right. Gold. This is logical. It is factual, and it's been repeated throughout world history. It does, talking about, and again, he highlighted about, let's face it, gold as the key hedge here, recommending everyone. Think about this. He's telling everybody, you better have 5 to 15% of your money in gold. Could you imagine, put it this way, if 401ks, if all the people that had because that's where you want to see, they don't let you really own gold in your 401ks, but imagine if you just took 1%. Jason, there wouldn't be any physical gold for people to buy, right, at that point, right? That would be too much demand. And, of course, Dalio was talking about, hey, you need to have 15% of your money in gold. It does very well when other asset classes don't do well. It is the only effective diversifier. So, guys, here it is. Whether it's trade wars, whether it's sovereignty wars, you name it, right? Just flat out wars. Every country is looking to dump U.S. debt right now. I don't know, Jason, is there a country that isn't? I don't know if there is one.
I don't know either. I was listening to that. I think you've got a good observation on that. You're right. I mean, what other factors, I guess, should we consider, right, Joe? Yeah.
That's the thing. I don't know what comes next. Right. If enough of these, whether they're pension funds, actual government, sovereign wealth funds, start dumping treasuries. Look out, here's the problem. They're definitely getting out of the Japanese yen. How about this, though, out of India today? Man, do things happen fast. They are now proposing that BRIC nations link their official digital currencies to enable cross-border trade and tourism payments in a move to reduce reliance on the U.S. dollar. According to Reuters, the Reserve Bank of India has recommended that a proposal to connect BRICS central bank digital currencies be put on the agenda for the 2026 BRICS Summit, which India is going to be hosting. And what they're saying is, if approved, this would connect the digital currencies of Brazil, Russia, India, China, and South Africa to improve efficiencies in trade finance and tourism payments while reducing transaction costs, right? In other words, let's stop using SWIFT altogether, and we'll just digitize our central bank currencies. Jason, I think this is something where, again, little by little, every time it seems like the BRICS guys see an opportunity, they make another. Hey, we're going to cut our dependence a little more, and a little more, and a little more. And now India is saying, hey, let's just get our digital game going. Yeah. What comes next? Well, I don't know. Is it digital? I think it is. We'll be back after the break. $20 gold pieces. $48.95, 20 or more, or 10 or more. $48.75. Rolls of U.S. silver eagles. I don't know how soon. Every day I'm coming in and they're going to be like, nope, there are none. This, right? I don't know. They're 21.25 right now. Boy, I'm looking at this. I don't know what Japan can do here. You know, the easy thing, I was sitting there saying, man, they've got to come out and go back to massive quantitative easing. The problem is the Japanese yen, it's at 158. And this 160 level has been the level where Japan has been trying to stay below. If they announced quantitative easing, could we see 200 on the yen? I mean, wow. And again, there's no good choices. We don't have good choices. Japan doesn't have good choices. Europe doesn't have good choices, right? Jason, the whole world, nobody really has any good choices.
Inflate your way out. That's the choice.
That's the choice. It seems like they're all going.
And we're looking at a big one, man. I was talking to somebody who's, watching this stuff pretty closely yesterday, and he was asking my opinions, and I've been saying on the air that there was a huge boom of money coming in. Now I've got some numbers to go off of. This $4.7 trillion, which I mentioned when Joe was out for a couple of days, and then I talked to Joe on the air yesterday. That it's also staged. It's like 1.2 trillion, and they don't want to call it stimulus this time. Tax returns. Oh, it's the tax cuts. The tax cuts. It looks like this. It's not. You know what it is? It's stimulus. It's stimulus. This is not tax cuts, and Trump is a hero for
they call it a different name, so it doesn't count, right?
Well, I think stimulus has a negative connotation now. I think people hear stimulus, they think, oh, that's going to be bad for the economy. They hear tax refund, yay! 1.2 trillion. How do they even do that? 1.2 trillion in tax returns. I'm guessing there's some big guys getting some big tax returns, I guess, because there's no way the average worker is going to get 1.2 trillion. But from what I understand, a lot of this is just going to flow right into this starting late February. And then there's going to be this 2.4 trillion. Companies like to keep a lot of assets offshore. You don't put all your eggs in one basket. Well, there's going to be a no fee, no penalty, no tax. Hey, bring your money back into America. I think it's only going to be for this year, right? Hey, you got 1 year.
We haven't seen that yet, but
that's going to be later this year. So in the middle of the year, this 2.4 trillion is coming back. Now, from what I understand, a lot of these big companies are going to be getting this money. This isn't for the average person. What do you think these companies are going to do? The main thing they're going to do is they're going to buy their own stock. They're going to prop this stock market up when it should be failing. And then later in the year, another 1.2 trillion going into industry, especially like copper. I've heard copper and mining and industry are going to get a big, essentially a stimulus. And this money is going to work. Look, everyone's going to feel good for about a year. I think housing prices are going to creep up. Instead of just going sideways or going down like it was last year, kind of creeping down, we're going to get record housing prices. Can you imagine with a glut of houses and nobody's, the rates are coming down, right, Joe? The rates are coming down. Time to refinance. This is your chance to move. And we're going to hear this later this year. Oh, we might have this looks like we might have inflation. The Fed might have to raise the rates in 2027. Can you imagine the rush of people that are going to be hearing this and want to get into housing now this year and give it, once again, bubbling it up, a housing price that doesn't need to go up? Inflation galore, Joe. That's the whole world. Inflation. They need to get the Japanese to stop raising the rate so they can, inflate their GDP to 500 to 1? It's insane. And the guy I was talking to, he's like, well, it seems to me that maybe could this get as bad as 70s inflation? I was like, yeah. And look, we've already had our first inflationary bump, and then it came down a little bit. If you look at 70s inflation, it went up and it went down, and went up and it went down. I think 3 times up and down, Joe. Raise the rates, lower the rates. Raise the rates, lower the rates. They couldn't control it. Sure looks like that's what we got now, Joe. We're going to have a whiplash effect, right? Lower the rates, raise the rates in rapid fashion.
Yeah, I think the big problem is going to be something breaks.
Something breaks, yeah.
That's the
that's when COVID shows up magically. when something breaks, right?
I don't know. We all know it's unpayable. Yeah, I wish I had a better answer than the answer I've been giving you guys for the last 25 years. You need to have more gold. You need to have more silver. You just do. Look at Ray Dalio today in Davos. Hey, guys, there's one place that has proven to be the winner in these types of situations. And, you know, I'll be honest, I've never been through where countries in the world decides that, hey, we don't want to own as much of the world's reserve currency anymore. Right? That's the new part. I don't care about the Japanese yen. The problem is the yen, it's like a domino effect. And then everybody is looking to get away from debt money. That's what you need to be doing. Be your own central bank.
Hey, Joe, let me give a prediction. When I talk about, somebody was asking me about everything going up. Why I like gold and silver so much better than everything else. 1 year from today, so it's January 20th. Here's some light predictions, Joe. How about this? I think 1 year from today, a $500,000 house will be worth $525,000. That's 5%. I think the 48,000 Dow in 1 year. I think the Dow could be 60,000. 1 year from today, not later this year, but let's just say 1 year from today. That's how much the prices and the inflation, the spending is going to push. That's 25%. 48 to 60, that's 25%. Hey, the stock market is going to be looking good this year. I think silver could be $200 in 1 year. That's 100% better than where it's at today. This is why I like gold and silver. The ups are going to be better, and then when this thing starts to collapse and have some sort of a recession or a market crash, gold and silver will go down with it. But it ain't going to, first of all, it'll have gone higher over this next year, and it's going to go down less when things hit hard. And there's going to be a day of reckoning, Joe. No matter what, they're going to have to let some air out of the tire. It's going to be too inflated, and they're going to raise the rates. And boy, you're going to be happy to be in gold and silver, Joe, when all the money games with stock buybacks. You think these companies are going to sell the stock after you sell it? No, they're going to sell it before you sell it. They're going to get their money out, Joe.
I have one worry in all of that, right? Because that is trends that we normally see. I don't know what rates are going to do, right? That's the problem, right? Are we going to get that lower interest rate?
Yeah, I think so.
That will determine whether Wall Street's 60,000 or 52 or 3, right? I agree with you. I think Wall Street goes up because it's so much money. People have no idea. I can't even really explain how much money all these countries in the world are spending and are getting ready to spend. And it really is going to be something where I think Jason's just nailed it. I mean, I'll give you want predictions. I mean, I don't like to predict it, but I'm pretty good at it. Right? Today's move in gold. We have now opened the window to 5,000. We're on 5,000 is on. If this was the NFL draft, right? The 5,000 is now on the clock.
Yep.
Very important key levels.
And silver's looking to go positive. It's only down 9 cents right now. So
and silver. Listen. The hard part for me with silver is I don't know. And what I mean by I don't know is it 150?
Right.
Is it 200? Gold, don't be surprised. I don't want anybody to be surprised that gold is approaching $7,000 at Christmas time, maybe 8.
I agree with that.
Don't be surprised at $200+ silver. I'm just telling you.
And that could be the low end of it if this spending is as drastic as it looks like it's going to be.
And right, that's the thing. The spending we know is coming. It's the interest rates that we don't know. That's the only thing of how high will they go. 800-951-0592.